supply and demand, order blocks. Let's go a bit deeper into supply and demand zones, also known as order blocks. These zones represent areas where big buying or selling happened in the past, creating sharp price moves. A demand zone forms when price shoots up from a certain level, showing strong buyer control. A supply zone forms when price drops quickly from a level, showing strong selling pressure. These zones often act like advanced versions of support and resistance. They're used by smart money and institutions. And when price comes back to them, they can offer high probability trade setups. Fibonacci retracement. Let's talk about one of the most powerful tools in technical analysis, Fibonacci retracement. This tool plots horizontal levels based on Fibonacci ratios, which often act as key support and resistance areas. To use it, identify a swing low and swing high on the chart, drag the Fibonacci tool from the low to the high, watch how price pulls back to levels like 0.382 or 0.618. These are common bounce zones. If price reacts at one of these levels, it might signal a strong buy or sell opportunity, but always combine it with other tools or confirmations. Never rely on it alone. Volume indicators. Volume shows the strength behind price moves. Let's break down the key ones. Volume bars. Taller bars mean more trading activity. VWAP, volume weighted average price, works like a moving average and shows dynamic support or resistance. Volume profile. Instead of time-based volume, this shows volume at specific price levels, useful for identifying entry zones. Volume helps you confirm whether a move is real or just noise. When price moves with high volume, that's strength. When it moves without volume, be cautious. Trend lines. Now, let's simplify things with trend lines. Trend lines are diagonal lines drawn on a chart to show market direction. In an uptrend, connect the higher lows. In a downtrend, connect the lower highs. When price pulls back and touches a trend line, especially with other confluence, that point can be a solid entry. Trend lines make trends easier to spot and trade with confidence. Candlestick patterns. These patterns reveal market sentiment just by looking at the shape and behavior of candles. They help you understand who's in control, buyers or sellers, within each session. Let's cover some important ones. Engulfing candles. A large candle completely covers the previous one. This shows strong momentum in the engulfing direction. Hammer and shooting star, known for their long wicks, they show price rejection and potential reversal points. Doji candles, when open and close prices are nearly the same, it shows indecision in the market. Traders use these patterns to anticipate price moves, especially when they appear near key support or resistance. Oscillators. Oscillators are great for identifying overbought and oversold conditions, especially in ranging markets. And let's look at two key ones. RSI, Relative Strength Index. Below 30 equals oversold equals potential for upside bounce. Above 70 equals overbought equals possible price drop. Stochastic oscillator, similar to RSI, but with two lines. Crossovers between the %K and %D lines give extra signals. These indicators help you avoid entering at extremes and time reversals more precisely. Divergences. A divergence happens when the price is doing one thing, but your indicator is doing another. For example, price makes higher highs, but the MACD makes lower highs. That's a bearish divergence. Price makes lower lows, but RSI shows higher lows. That's a bullish divergence. Divergences warn that a reversal might be coming. Even if the trend still looks strong on the surface, they're powerful when combined with support or resistance or patterns. Dynamic support and resistance. Unlike fixed horizontal levels, dynamic support and resistance moves with price. We usually use moving averages to find these. For example, if price keeps bouncing off the 50 EMA from above, it becomes dynamic support. If price gets rejected from the 200 EMA from below, it acts as dynamic resistance. These levels help track trend strength and offer flexible entry ChoCh exit zones as price evolves in real time. Market structure. Market structure simply describes how price moves in a market, whether it's trending or ranging. An uptrend means prices consistently form higher highs and higher lows, showing that buyers are strong. A downtrend is when prices create lower highs and lower lows, indicating sellers are dominant. In a ranging market, prices move sideways without a clear direction, staying between key support and resistance levels. Recognizing market structure helps traders decide when to enter or exit trades effectively. Understanding this is the first step to becoming a confident trader. Now let's talk about one of the most used concepts, support and resistance. These are horizontal price levels where the market often reacts or reverses. Support is a level below the current price where buying activity typically increases, stopping the price from falling further. Resistance is a level above the current price where selling pressure usually appears, preventing the price from rising higher. Traders use these levels to find potential entry and exit points, because when price bounces from support or gets rejected from resistance, it tells us something important about buyer and seller strength. Next up, breakout patterns. A breakout happens when price makes a strong move after being stuck in a tight range or consolidation phase. Typically, when price stays in a small range for a while, pressure builds up, and eventually that pressure explodes, either up or down. Traders watch for patterns like wedges, triangles, or rectangles because these shapes often signal that a breakout is coming. Spotting these early gives you an edge. You're ready to enter as soon as the breakout begins, maximizing your gains and managing your risk. Reversal patterns. Now let's flip the story. Reversal patterns. These patterns signal that a current trend may soon change direction. They help you spot turning points in the market so you're not entering too late or holding too long. Some of the most important reversal patterns include double tops and bottoms, triple tops and bottoms, head and shoulders, and the cup and handle formation. These patterns typically form after extended trends and act as early warnings of trend exhaustion. Recognizing them gives you a chance to catch major moves before the crowd does. Break of structure. Boss. A break of structure happens when price breaks a recent high or low in the trend. For example, in an uptrend, when price breaks a previous high, it confirms buyers are still in control. In a downtrend, breaking the previous low signals, sellers are strong. Boss helps confirm market direction and is often used to validate entries or continuation trades. Change of character, or ChoCh, is a signal that the market may be shifting direction. For example, in an uptrend, if price suddenly breaks below the previous high or low, that's a bearish ChoCh. In a downtrend, if price breaks above the previous lower high, it could mean a bullish reversal is coming. ChoCh is one of the earliest signs of trend reversal. It helps you get positioned before the big move, while most traders are still caught on the wrong side. Momentum indicators. These indicators show how strong a trend is and whether it's likely to continue or fade. Let's go over the popular ones. MACD, bullish when it crosses up, bearish when it crosses down. Moving averages, price above is equals to bullish bias, price below is equals to bearish bias. Parabolic SAR, dots below price is equals to uptrend, dots above is equals to downtrend. Supertrend, green is equal to bullish, red equals to bearish. These tools are great for trailing trades, confirming entries or avoiding early exits. Fair value gaps represent imbalances between buyers and sellers, often leading to sharp price moves. To spot one, look for a large-bodied candle. Identify the gap between the wick of the candle before and the wick of the candle after. That space is your fair value gap. These gaps often act like magnets. Price tends to return and fill them before moving on. They can offer sniper entries when used with structure or supply and demand zones. Heikin Ashi is a smoother version of CandleStick charts. It filters out market noise and makes trends easier to see. Green candles usually signal an uptrend. Red candles suggest a downtrend. The bigger the candle body, the stronger the trend. But remember, Heikin Ashi doesn't show real-time price, so always combine it with real candles or confirmation signals for precise entries. Gann Angles. Gann Angles use diagonal lines based on time and price. The most famous one is the 45-degree angle, representing a perfect one-to-one relationship between time and price. The steeper the angle, the stronger the trend. When price breaks these angles, it can suggest weakening momentum. Gann tools can be tricky, but with practice, they offer unique trend analysis perspectives. Renko Charts, they ignore time and focus only on price movement. Blocks, called bricks, form only when price moves by a set amount. Green bricks are equals to bullish moves. Red bricks are equals to bearish moves. This helps remove market noise and makes trends super clear. But remember, you don't see real-time candles or volume. By understanding all these tools, from market structure and patterns to advanced concepts, you build a complete view of how price behaves. The more you combine these concepts with live chart examples and backtest them, the more confident and profitable your trading becomes. This video is for educational purposes only. I'm not a financial advisor. TradingView.com charts are used in this video. Please do your own research before making any decisions.